Hi everyone. Good evening, everyone. Can you guys hear me? Hello, can you hear me? Can you hear me? You can just let me know. Am I audible? Hello? Hello? Can you guys hear me?
Yes, we
Yeah,
can hear you.
I can hear you.
Okay, fantastic. Fantastic.
Yes, you can.
Okay, great, great. We'll just have to kick off immediately. Good evening, everyone. Okay, great. Good evening, everyone. My name is Promise. The managing partner with BFI Insight. And today we are going to be looking at the topic, understanding bankability in project finance, key factors for successful funding. And Victoria is going to be the one to anchor today's webinar. So ideally, this webinar is something that we are looking at. We are looking at having regular webinars, right? I mean, BFI Insight having regular webinars on project finance. So this is one of the few webinars that we're going to be seeing. So we hope that we're going to see more of the webinars. I think for this month alone, we have 3 webinars for this month that is touching costing across project finance, the finance part of it, the modeling part of it, and as well the legal part of it. Okay, so it's quite a great opportunity to have everyone join this webinar, and I believe that it's going to be an insightful one. So I will hand over the mic to Victoria so she can go ahead with her presentation. If you have any question, if you have any clarification, you can as well let me know, please, so we can be able to answer that before we proceed. Any question? Any question? Any question? Anyone? Any question? Okay, I guess we're fine. So, Victoria, you can go ahead. Thank you.
Hi, good evening, everyone. Can you hear me? Can you guys hear me?
Yeah, I can hear you clearly.
Okay, great. Good evening, everyone. Very nice to be here to talk about bankability or bankability considerations in project finance. It'll be good to know where people are dialing in from. Can you put in the chat like where you're dialing in from, so we can have a bit of an interactive session to kickstart? Okay, I actually can't see the chat, so I'll assume people are putting things there. But very good to be here. I mean, the whole focus of today's class is really to just talk about the bankability considerations, but we really can't do that without setting some context and giving some brief background. So I'll spend the initial few minutes on that and then go into the actual bankability considerations and some kind of project appraisal consideration discussion before we then give room for questions. But while I'm speaking, if there are any questions that you have, you can put in the chat, or you can raise up your hand. Although I won't be able to see you, but once I finish the presentation, I'll be able to see the hands, and I can then call on people to speak and ask their questions. Okay. So let's just set a brief background about what project finance is all about. Project finance. Oh,
I sharing the screen?
Is my screen?
Okay.
Okay, maybe I need to reshare then. Give me a moment. Can you see my screen now?
Yes, we can. Yes.
Okay, great. So, I mean, it's good to start from defining what the concept of project finance is, right? So project finance is really the funding of large, long-term, capital-intensive infrastructure and industrial projects. Let's take note of some of the keywords used in this definition, right? So the thing called large. So large means it's usually of massive scale, of massive size, Usually, if it's like a refinery, many thousand barrels of crude are usually produced from such refineries. If it's like an airport, millions and millions of people would have to use that airport. So it's usually very large. Long term, in the sense that it is usually over a long period of time in terms of like when the construction is done and the actual operations period, right? So that's the long-term piece. Capital intensive, because it's usually large, there's a lot of capital required to develop such projects, right? So think about like an airport, for example. It usually is millions and millions of whatever currency you're referring to. So it's usually very capital intensive because of the large size. And then it's usually either infrastructure or industrial projects. But what makes project finance very, very unique from any other type of financing, be it corporate financing or financial institutions lending or sovereign lending, is the fact that it's usually a non-recourse financing. And I'll explain what non-recourse means in simple English. So non-recourse just means that if the project that is being developed through that financing doesn't materialize and you don't get any cash flows to pay your money back, the lenders do not have any recourse to the underlying or the company that is developing the project. Usually something called a special purpose vehicle is set up for the primary purpose of developing this project, right? And then when the project is developed, usually the cash flows from the project is what is used to repay the loan. So there are two things that make project finance stand out: the non-recourse nature of project finance, as well as the fact that it is solely reliant on the cash flows to get its money back. So at every point in time as a lender, you're always thinking, how can I preserve the cash flows of this project to ensure that I can get my money back, right? And then the non-recourse nature is, as a sponsor, you're also trying to ring fence the project to remove it away from all of your existing other assets, so that in case there's a default or the project doesn't materialize, the lenders have no recourse to you, right? So let me give like an example. Let's think about, let's say, for example, a refinery project. Let's say the Dangote refinery, for example, or like we're recently doing a mine in Sierra Leone. Let's take a mine in Sierra Leone, for example. There'll be a project sponsor that's trying to develop the project, right? They have the idea that they want to build this refinery that will help substitute and refine crude in the country. Then they go ahead to do some studies. They see that there's actually a business case here. And then they then go ahead to indeed start putting in some money. But before they even start putting in some money, they need to set up the thing called a special purpose vehicle, which is just really a company that's incorporated for the sole purpose of developing that project. And by doing that, they're able to then ring fence their other assets and other things from this financing. Okay, so I don't spend too much time on that. What are some of the main features of project finance? Let's just run through this quickly. Usually it's capital intensive. Like I mentioned, it's usually millions and billions of dollars, pounds, euros, naira, rand, any currency you can think of, right? It's usually very capital intensive. The second main feature of project finance is that it's usually limited or no recourse financing. So described extensively, there's usually a special purpose vehicle that is set up for the primary purpose of this project. And if there is a default or if the project doesn't materialize, then the lenders don't have any recourse to the ultimate company or the developer of the project. So the recourse stops with the project company. It's usually long-term in nature, usually like 10 to 15 years, just because of how huge the size is. So the debt is usually spread out so that they're able to repay comfortably over the time. And usually there's an independent entity with a finite life called a special purpose vehicle that is set up for the sole purpose of this project finance transaction. Also, there are usually very many participants. So you would have from the technical advisor to the legal advisors to the insurance advisors to the financial model advisors. This is all on the lender side. And from the project company side, you would have the contractor they're working with. You would have your operations and maintenance contractor. You would have like the different suppliers. So it's just so many parties that are involved in project finance transaction, right? And because there are many parties, there need to be many contracts, because the last point there, that allocated risk, is so important, because project finance is all about allocation of risk, right? So at every point in time, you're trying to allocate risk to the party best suited to bear the risk, right? So And you do that mainly through contracts. And I think next week we're going to be having another webinar on like the legal element. So you usually pass on those risks because it through contracts mainly. And the theory is usually that if something is not written, it's not there. So whatever construct, whatever mechanics you have in place for the whole agreement or whichever party needs to be documented in very clear terms to the party so that everyone knows their responsibilities and their rights. Also, it's usually very highly leveraged. So they would usually take on more debt than they have equity, usually because debt is usually a cheaper cost of capital than equity. And then the repayment, as I mentioned before, is from project cash flows mainly. And then there's serious risk allocation that is done in project finance. I don't know if there are any questions at this point. Let me just quickly check the chat. Or please, Justice or Jibo, please let me know if there are any questions that I'm not seeing, please. Thank you.
Yeah, sure, I'll do that. That's fine.
Okay.
If you have any questions, you can as well post it on the comment box. I can as well speak, whichever.
Okay, great. So you can still see my screen, right? Jibo and everyone.
You can, yes, you can.
Okay. Now let's talk quickly on the typical parties in a project finance transaction. So this is also important because when you start thinking about bankability, you want to understand how you're allocating risk to these different parties, right? So first and foremost is the special purpose vehicle, which is usually the main party in the transaction because that's the party that is most times contracting with the different other sub parties in the transaction. So the special purpose vehicle is the hub. So now let's use like an example, like a real life example for this. So I was talking about a mine in Sierra Leone. Let's just call it, I'll just say random mine. Let's call it a bauxite mine, right? So these developers, they have been doing bauxite mining for a while. They realize that there's some bauxite reserve in Sierra Leone, right? What's the first thing they do? Initially, even before they start doing their studies, they set up a special purpose vehicle. So a company that is incorporated in Sierra Leone, that will be the developer of this bauxite mine, right? So that's the special purpose vehicle. The sponsors here, let's call them XYZ Limited. So XYZ Limited are the sponsors of the company. There'll be a contract between, the contract's coming later. There'll be an agreement between the sponsors and the SPV, right? Because obviously the sponsors would do some pre-development work, put in some money initially, and also when the more substantive financing is to come in, that's the debt and the equity contribution needs to be documented in an agreement, right? So there's that contractual agreement between the sponsor and the SPV company. Also, because this project will not be done in a vacuum, it will be done within a country and within confines, there will be need for interactions with the government, right? So the government most times is the party issuing licenses or giving concession agreements or giving some kind of like rights to basically mine those resources or basically explore that opportunity you're trying to explore. So there's usually some concession agreement or license, or in mining, I think they call it mining license, that will be given by the government to the SPV, and it will set out in very clear terms what they mine, what the area they can mine, and then how long they have the license for, etc., the termination rights on both sides as well, right? Then we also then have the offtake purchaser. So in my scenario of a bauxite mine, right? The production that will be happening will be refined bauxite, right? Bauxite is a mineral that is used to produce aluminium, for people that don't know. So they would have to ship out or transport bauxite out of Sierra Leone to wherever they would take to go and produce the aluminium that they want to produce, right? So this offtake usually is that guaranteed purchase, right, from a third party. Because as a lender, let me even just ask in the chat, as a lender, if you're giving somebody money to develop a project, remembering that the project relies solely on the cash flows of the project, do you want to be sure that there's a guaranteed buyer or not? Let me see what people are saying in the chat. I can't really see the chats, but do you want to have a guaranteed buyer or not? Let me hear. If you're a lender giving them money, I mean.
Great. Ndukwe is raising up his hand. Ndukwe can speak as well if you want, if you have anything to say.
Okay, please go ahead.
All right, thank you very much. I mean, offtake is a no-brainer now. I mean, if you want to lend somebody money, you should have factored in end to end of the project, from financing to offtake agreement and the likes. So it's a no-brainer. It should be part of the whole process. Thank you.
Okay, that's good. That's good. Generally, it's a no-brainer, but there are some minerals that have like some peculiarities, right? I mean, when I mean peculiarity, doesn't mean you wouldn't have any offtake at all, but you would probably just have like a percentage of offtake. So let's say you cover 30% of the offtake, because the assumption there is that you probably can get a better price in the market at market price, right? Because in offtake, what you're basically doing is you're locking in sometimes the price, sometimes the volume, but most times it's usually a volume lock-in that they will guarantee to purchase, like, let's say 10,000 barrels or whatever amount of crude, or how much bauxite you produce, right? So, but sometimes some people also want to lock in a price. So, and then that's where it can get tricky as well. But yes, offtake is super important as a lender. You want to have guaranteed purchase. I think you may have lost my screen, right? Okay, I think it's back now. Is it?
Yes, it is.
Okay, so that's really what an offtake is, and these agreements with the SPV. On the other side, right, as a if you're you're producing, if you're in a project that is producing something that needs an input, right? So in bauxite, there's no input per se, because you're just mining a resource that is already there. But let's say something like crude, right? A refinery, you need like the raw crude for the refinery to then process and then bring out refined crude, right? So in that scenario, you will need something called an input supplier on the other side that will sort of guarantee you a certain volume of inputs, so that you would always at every point in time have what to process through your plant and then produce your output that your off-taker will take. So on the next party that is usually very critical to project finance transactions is the construction contractor. And this is usually called the engineering, procurement, and construction contractor, EPC, right? So, and this is the party that is most times developing the actual plant, or the actual whatever, if it's like a plant, if it's like a refinery, they are the ones with the technical expertise to develop such projects, right? Usually engineering firms or technical companies that have done it for many, many years. And they would then have like an EPC contract with the SPV company that sets out what they're supposed to do, the specifications, and also shares allocates risks to them. Because, for example, when a construction contractor is developing a project, what are some of the risks you think can occur in terms of, like, from the contractor side? What are some of the things? What do you guys think will be some of the things that can happen that would cause the project not to happen from the contractor side? I mean, let me hear what people are saying in the chat.
Okay, so can I say something?
Sure, go ahead.
Some areas that may affect the project would be maybe the devaluation of a currency, regardless of if it's coming from a country.
No, but I said from the contractor side. Remember. So what can happen from the contractor side that will make project not happen?
Well, okay, so maybe for specific equipment they may require, maybe they don't have it on ground or on site, so the mobility as well.
Okay.
And also time frame, environmental factors, which you can't entirely, you don't have control over that. So you need to factor that in. Those are contingencies that cannot be overemphasized.
Okay.
I think that's just basically it. That just crossed my mind. Yeah.
Okay. Any other thought? Thank you so much for that. Okay. Any other thoughts on what other things can happen from the contractor side? They might be the procurement of substandard materials. Okay.
Hi everyone. I would say maybe failure to construct within a particular time frame. So like them
Exactly.
bypassing
That's a major risk.
Yeah.
Yeah, because what then happens? What's the implication of that? Let's talk about that. Like, if you say in your contract you're going to build this thing within 21 months, and you don't then build it in 21 months, what are the implications?
Definitely, you will not be able to like start off the project at the expected operation start dates.
Okay. Any other ideas?
Okay, my thoughts would be on that basis. My thoughts would be, I think during the sign off, there should be that leeway of, any other contingencies that may occur along the construction. I mean, like I said, you cannot overemphasize environmental factor. So there should be a leeway to say, oh, peradventure, this doesn't happen within the set time. So there should
Mm,
be a clause, to protect the contractor and all that. Yeah, but I know it could be achieved within a set time or not, basically.
yeah. So certainly, like I think it was Moses speaking earlier. Okay, sorry, go ahead.
Yeah, I was just going to add an implication could be increased delayed finance costs to the project
Okay,
company. So,
okay,
yeah.
okay, okay. Yeah. So all of these are very important points that you have all have raised. Thank you so much for engaging. Also remember, like, what is the main source of repayment here in this project finance? Can someone remind me?
Project cash flow.
Project cash flows, right? So it then means like if there is a delay to construction, then there's automatically a delay to what operations, which would then cause a delay to your cash flows. So everything is so timed, and that's why project finance, even the modeling, is like literally done like on a monthly basis. Because if you don't track it that granular, you would like not be able to track your cash flows, right? So a delay to construction means a delay to operation, means a delay to getting your cash flows, means a delay to the loan. Like, so it means restructuring will already begin. So that's why, like, at every point in time, enough contingencies need to be built into one, the contractor's schedule. So that their schedule they are working with, they can't, like, in the contract they're going to sign, they won't put a very aggressive schedule because they need to consider all the factors, environmental factors, as much as they can. Obviously, they wouldn't be able to give such like hand on heart because they don't control the future, right? But there would then be also further guarantees and bonds they would give you at the end, or completion guarantees that to be sure that okay, this thing will be completed in time. And then if there's any cost overrun as well, they would indicate, like they could give you like a completion or performance bond, for example, if the thing doesn't perform to the standard, right? They could give you like liquidated damages. So just basically things to cater for any extra delay that may be caused from their side. So they outline all the risks that can happen from their side, and then they give you some mitigants. Like obviously it's negotiable, but usually it's already catered for in the agreement. So I just wanted to spend a bit of time there because it's so important to know like some of the things that the construction contractor, a delay there can cause on other aspects of the project. So another element here is the operator. So the operators and maintenance, this is after the construction period, right? So now someone now needs to operate and maintain this plant or the refinery or the mine or whatever. So this is also very, very important because we've seen, especially like in our developing countries, we see a lot of lack of maintenance culture, like affecting a lot of projects, right? So this is actually super, super important. So now let me ask a question. If you are a lender, remember, you're wearing the hat of a lender. If you're a lender and a company, like somebody that is developing, let's say, a refinery that has never built a refinery before in his life, got a technical person, he got a technical EPC to build the refinery, but then says that he's going to operate and maintain it with his own local team, would you be comfortable with that? Let me take the question again. You're a lender. The person has gotten a technical EPC contractor to build the project, the mine or the refinery. But now they're saying that they will use their own internal team to do the operations and maintenance. Would you be comfortable with that? Let me hear what people are saying in chat, or feel free to unmute and speak. I'm listening, Ndukwe. Hello, Ndukwe, wait, did you want to speak?
Can you hear me? Can you hear me now?
Yeah, I can hear you.
All right. So, like I said, for me, if I was a lender, it's a no-no because I mean, you don't have that technical expertise to build
Okay.
and operate. Then you now want to operate. I mean, if it's building and I see the viability, why not? It's understandable. But to operate, it's best we get a professional, so at least we even know where the monies are coming from. And I
Okay.
mean, yeah, exactly.
Okay, exactly, right. Or worst case, you would say, okay, you would partner with them. So, like, let's say you get the operations and maintenance experts, but then maybe they'll be training your local staff, right, for a period of time, and then over time you would then take it over. But you cannot say like from the get go you want to operate and maintain it yourself because you don't have the expertise in it, right? So that's just some of the things you think about when you're structuring the transactions. Then obviously the lenders are the people providing the debt financing to the project, and that needs to have a loan agreement with them, and that clearly outlines the terms of the loan, the tenor, the moratorium, the grace period, and all of that. Okay, moving on now. Let's talk about some of the general bankability considerations, right? And this is actually the meat of today's session. What I was just doing earlier was giving you a quick breather. So, what do we mean when we say a deal is bankable? Um, So I like to describe it in simple English. Like here, there's obviously a technical definition which says, oh, it's when a project is risk return profile meets investors' criteria and they can secure financing to implement the project. But that's really a technical definition. The way I like to define it simply is bankability is, as a lender, when a deal is bankable means I can get my money back. So the question you're always asking yourself as a bankability, like when you're thinking about bankability, is what are the things that can make me get my money back easily? Right? Because remember, the deal solely relies on the cash flow of the project, right? So at every point in time, you as a lender are trying to think about ways that you can ring fence that cash flow so that you ensure that it comes to you, right? And usually these considerations are from a lender's perspective. So let's look at some of the things, and we'll be talking about this. It's going to be very interactive, so I'll be asking lots of questions. I'm sure people can tell that I like to ask questions. So approach to risk sharing. Usually, there needs to be a fair and reasonable approach to risk sharing. So, as I mentioned before, risk needs to be allocated to the party best suited to bear the risk, right? And whenever I'm having this session, I always like to ask this question. So, if someone wants to build a toll road, for example, a toll road, right? A road that they want to build a new road and they want to put tolls on it. Who is the party best suited to bear the risk that people will pass that road? Let me hear what people are saying in the chat. That's a question for the group. Please put your answers in the chat. You're a developer, you're the project company, you've set up an SPV, you want to build a toll road. You're a private company, right? But the question is then, who is the party best suited to ensure people pass a toll road or you pass any road? Okay, so Emmanuel said the construction team. Okay, any other thoughts? Feel free to unmute and speak as well if you want to. Okay, government or concessionaire. Okay.
Well, for me, sorry, can I say something? I would say, would I say, exchange of development in both opposite angles of where the toll gates are situated. I mean, regardless of government, regardless of the construction, there should be some form of exchange of development. Why would I want to
What does that
cross a
mean?
Lekki? Why would I want to cross a Lekki toll gate if I'm not going to maybe Lekki Phase One or Aja? So there should be something that is attracting me in Aja there that I would need to go and see. It could be the beach, it could be an event center, it could be anything. So, but
Mm,
if it was on the mainland, why would I want to cross the toll gates? I would rather stay on the mainland. So there
no,
should be
so
some
the
form of
scenario I'm
attraction.
painting here is like
Okay.
there's already a road that exists, but you want to, let's say somebody feels like there's a faster way that can get people to somewhere, and they want to build a toll road along that path. But there's already a road that exists. And the question when lenders are giving you money in that scenario, because your main revenue source will be the tolls you're charging people, right? So it then means that if people don't pass the road, you don't earn tolls. So who is the party to ensure that people pass that road? Is my question. So let's assume development is equal across. Like let's not begin to get granular in the analysis. Do you understand what I mean?
Okay, I understand. It's okay. Well, the government is a factor, no doubt. But I mean, businesses can also play a vital role. Businesses.
Okay.
That's my
Okay.
thought, though.
That's good. Okay. I think personally, I think it's the government, because it's the government that can say, oh, this road is now blocked for this period because this, like, we want everybody to use this existing road, right? So I don't think private individuals will have such power or such stakeholder goodwill, even within communities and whatnot, to say, oh, because I'm building this or that toll road, everybody should pass here. Usually it's governments that can ensure people will pass there. And that's why in some scenarios, and most times that's why we even see governments that are the ones that take on like road construction projects, because they're the ones that have like that within their mandate. And they're the ones that can ensure people can pass a road, right? So that's just the way I think about toll roads in particular. But that's where, like, talking about approach to risk sharing. So ensuring that the party best suited to bear the risk is always bearing the risk, right? And it's usually a discussion and negotiation, because in one deal, one party can be able to bear a risk. In another deal, that same kind of sector, that party may not be able to bear that risk. In the same sector, let's say it's two refineries, one in Guinea, one in Nigeria. Let's say the Nigerian government may want to take on some risk, for example, but in Guinea, they may not have the wherewithal to take that risk, right? So it's usually a discussion and negotiation point. It's not like a, I mean, there are some that are standard, right? Like off-take risk should be borne by an off-taker. It shouldn't be borne by like somebody that doesn't have experience or doesn't trade such commodities or whatever. But generally, it's usually up for discussion. It's usually very lengthy conversation among the parties.
There's a question. There's a question from Jose.
So, from who?
Jose.
Okay, please go ahead. Hello, who has a question? Sorry, I can't see the hand.
You can go ahead. Go ahead.
Okay. All right. So the next point is.
Oh, sorry. Can you hear me? I was muted. Apologies for that.
Okay.
I was muted. Yes, I didn't. I thought I was speaking. Okay. So this on the issue of the government, I know you spoke about the ability of government to ensure that traffic moves in the direction of that toll road. I'm taking on that example of the toll road. Can we say part of the risk, I mean, management, and in terms of government being the person, the entity that can bear that risk, that they will also guarantee some form of payment, assuming the traffic, the expectation for traffic still doesn't flow. Like for instance, in the case of Lake, you give alternative routes and you see a lot more people taking that route. So because the project company has loans, and part of the conditions for getting on that loans is that, okay, you ensure a minimum level of revenue so that you can meet up your debt payments. We say that government is beyond just ensuring traffic that road, they will also guarantee that they would meet up or make payments to the project company.
Yes, absolutely.
Happen? Okay.
Absolutely. Usually it's a negotiation point as well. Usually there's something called the minimum revenue guarantee that they would give in such transactions, so that in case the number of people they've estimated to pass that road don't pass that road, then the project will still be able to meet its cash flow obligations or its debt repayment obligations. Usually, so that guarantee is usually sized around the level of what the debt obligation is each period, and then it's it helps to buffer in case there's a shortfall. So yeah, absolutely. So that's another way like government is able to support such projects, and hence why like generally all these transportation projects are usually like government projects, because they are the ones that can do the studies, can ensure people can pass a road, can also give the guarantees needed to ensure shortfalls are taken care of. Okay, I hope that answered your question. Or I think that was a good contribution actually to just get everyone to know about that as well. Okay, consent and permits. This is also very, very important, because obviously you don't want to finance a project that has not legally and rightly obtained all of its permits and consents, right? So, and this needs to be done at the outset of the project. Like, you don't want a project where it's in the middle of the project, they're then going to go and say, oh, we've not gotten our licenses. That will not work, right? So usually they would have gotten their ducks in a row, gotten all the licenses, the permits, and then usually then you would then come in as a lender and review that. You have to do a legal due diligence on the consents and permits that have been given. So now let me paint a scenario. In a country, let's say you're giving a loan of, like a 5-year loan, right? Or let's say you're giving a 10-year loan, for example. But the permit they currently have is for 8 years. As a lender, would you be happy to support such a project? Let me hear what the chat is saying. The loan is 10 years, but their permit from when your legal DD review is showing that it's an 8-year renewable for another 8 years.
Hello, can I say something?
Sure.
For me, if I was a lender, right, I think it's a good set of why. What do I mean by that? 8 years and it's renewable in 8 years, and the lifespan is 10 years. There should always be a break even for every project finance, whether it's between first 3 years, 4 years, 5 years. The numbers should have already been done. So be a break even. And if the funding is for 10 years, but the license is for 8 years, and it's renewable, man, the only thing I would want to do as a lender, I would put in a contract into the renewal of the next license to be sure that the funding covers that actual 10 years minimum before we can now even, aside even the break-even period. So this is just my own thought though.
Okay. Good to hear. I see Williams in the chat saying no, he wouldn't. Who else? Let me hear a third view. William says 50-year no deal. Interesting. It'll be good to hear others what you think. Let me even see who are the people on the call, in case I know anybody. Okay, no other thoughts.
Yeah,
Enoch, I see you on the
something.
call. Enoch. Hello? Oh, sorry, who's speaking? Sorry, who's this?
This is Ose.
Okay, Ose. Okay, go ahead, please.
Yeah, so I would say that for me, from a lender's perspective, it's not properly mapped. The reason being that even though it's renewable in 8 years, there's no guarantee, and that's the future. You have a loan extended for 10 years. What you would prefer is a scenario that you have, even if it's at least another year, let's say, a license or a permit or a concession for like 11 years, and you have your loan 10 or 10 years, or even you have more headroom. That way, you're certain that by the time, if you're doing your analysis and you see this is a bankable project based on your revenue estimation, you know that you can cover and recover your entire loan in 10 years, and leave the chance, that they would renew that contract beyond 10 years. So it's a no-go from a lender's perspective, from my point of view.
Yeah. So absolutely, I think it's really a commercial decision that will need to be made by the lender if they're comfortable. I mean, Ndukwe seemed to, if he was a lender, he would be comfortable from what he told us. But us, William, and maybe myself as well, we may not be comfortable. And so in our own lending scenario, we would ask for either some or maybe more like a DD, further DD on like the general renewal process in the country to know how easy it is to get it renewed, right? Because what you don't want is when you get to year 8, then there's now an issue with renewal. And although I hear you indicate that the project will already have,
there might be change of government as well.
Exactly. So many things can happen within that period of time that you cannot really control, right? And if they just come and evacuate you one day, then you have no cash flows to pay your remaining 2 years. So it's just very risky. Anyways, moving on, so that I'm conscious of time. So yeah, you need that to be in place, and also the government's willingness to renew the licenses. The third one is equity contribution. So this is really how much equity is going to be put into the project, because usually there are two main forms of capital that for finance, project finance. So it's debt and equity. And there needs to be an appropriate, the word there is appropriate level of equity, and appropriateness also relies based on the lenders, how risky the project is, what their perception of the riskiness of the country and the jurisdiction as a whole is. But generally, the rule of thumb, in a way, or just the general debt to equity ratio seen in the market is like 70 to 30 debt to equity ratio. But now let me just ask a quick question on this one. So if there was a project and the sponsors were only putting in 5% of the project costs, and then they were borrowing the remaining 95%. As a lender, would you be comfortable? And let's say is like a bauxite mine. Let me see what people are saying in the chat. Okay, Daniel.
Yeah, Daniel wants to say something. Then I go ahead.
Yeah.
We're listening. I can't hear you.
Okay. So, please can you hear me?
Yes.
Hello. Okay. So, for me as a lender, depending on how much the sponsors are willing to contribute to the project, it will give me an idea of they themselves how they perceive the riskiness of the project. So if they are not willing to put in much equity, then it means that they perceive the project to be very risky, and that's why they don't want to put in much equity. So I would also be a bit skeptical in terms of lending for them. And even if I would do, maybe I'll require a shorter payback period or a very high interest rate to make up for the risk.
No, that's a valid point. Exactly. So because this
Daniel,
okay.
Yeah, Daniel, where are you calling him from? Nigeria?
I'm from Ghana.
Oh, Ghana. Okay, cool.
Yeah.
Okay, go ahead.
Yeah. So yes, exactly. So there needs to be alignment of interest. That's what they call it, right? Alignment of interest between the parties. So someone that believes in this great idea cannot just be putting in 5%. Like you can't believe in the idea. Like I can't believe as a lender, I cannot believe in the idea more than you, right? So you need to show commitment to the idea that you believe in very strongly by putting in a bit more equity to show that like you believe in it, right? And also the timing of the equity contribution is so important as well. So whether or not, so typically as a lender, you would want the equity to be drawn upfront, i.e., you want the equity sponsors to have put in all their equity at the beginning of the project, and then your debt comes in later. But as an equity holder, you may not want that, right? Because that's just a lot of capital outflows at the beginning. You may want to draw down like pro rata. Pro rata meaning like based on the debt to equity ratio. So at every time they draw 70%, you draw 30% of your own equity, and like that. And that has different implications on the model as well. But it also depends on, you also need to check the financial strength of the equity contributors, right? Because like you need to be sure that they have the capital. It's not just about saying they will contribute 30%, but do they actually have that 30% to contribute, right? And they show that through like their financials, and they can also give guarantees and some kind of like support to show that they have it, or get some LCs from the bank to show that they have such equity. Okay, technical expertise and experience of the sponsors. This is so important because like you don't want people that don't have any knowledge on the project to be developing a project, or at least even if they don't have any knowledge, they should have equipped themselves with the people that have the knowledge, right? So experience of the various contracting parties, right? And not only the sponsor, but the EPC contractor as well. This EPC contractor, have they been developing bauxite mines in the past, or is this their first bauxite mine in life? Do you understand? So if it's their first bauxite mine in life, that's already like a red flag, because you ask yourself, okay, what's their expertise? Is it, have they done something that is at least close to bauxite in the past that they can use such skill sets to deploy in this one? Also, the O&M contractor, have they, what's their expertise? Even the off-taker, how big is the balance sheet of the off-taker? Can they actually purchase this thing they're saying they'll purchase, right? So evaluating all of this, you do it during the due diligence phase. You typically get like a technical advisor, you get a legal advisor, you get an insurance advisor, a financial advisor that will then assess all of the risks of these different components or these different parties and opine on them. So they will then give you a report that you would review as a lender. Also, the cash generating ability of the project, right? Remember, the project lives and breathes on the cash flows. So you need to be sure that one, the cash flows are robust enough and they even exist. So if it's like some new technology thing that someone is trying to do, you already be very skeptical about it. But if it's like technology that has been used before, then you kind of like will be a bit more comfortable. You would be happy that like, okay, at least it's been done somewhere before, and then you can then replicate it in this project. Because cash flows are so important. Another way of tying cash flows is getting the offtake, so that you know that, okay, certain amount of this produce will be purchased by this party at this time, so that you know that revenues are coming in steadily, right? And then just assessing it to you also do some stress testing, do some scenario analysis to check, in the worst scenario, will I still be able to get my money back? The last thing.
Yes, sorry, I have a question there, Victoria.
Sure.
Thank you for buttressing on this point. I like the fact that you mentioned, existing business and all that. So in a scenario whereby it's a new business, so
Mm.
they've gotten the technical expertise, and every other thing. As a matter of fact, they've actually started even construction, and
Okay.
they need funding, right?
Yes.
And they've shown some level of capacity, so to say. In a scenario as that, what would possibly be the ideal scenario of a lender in this case? You know, just maybe shed more light to that aspect, please. Thank you.
Sure, sure. I mean, the lender will still go through their general due diligence process, right? So they will still get their lender's technical advisor to even check the work you say you've done, right? Like that it's indeed like has gotten, because sponsors will say, oh, they've done 30% of the work, but somebody else can come and check and say, oh, it's actually just 20% they've done, right? So you need to check the work they've done, the monies they've put in as well, to confirm that indeed all those monies have gone into the project, right? And then even the contractor they've gotten. But most times, is as a sponsor self, it may be risky for you to just go ahead and start funding with your equity without knowing where your debt financing will come from. Because remember, the project is made up of two pillars, debt and equity, right? So unless maybe it's a scenario where they are already talking with the lenders, but they just started using equity to fast track some parts of the project. So in that scenario, the lenders will just DD all the work that they've done, get the different advisors to review, confirm that what they're saying is indeed correct. And then once they get comfortable, they go through their credit approval processes, get the approval, and then the mechanics usually will be like, okay, they would catch up with equity, right? Because equity will probably have funded the project to a particular point in time. So they will first catch up most times, and then from there they can then go pro rata. Or if the scenario is that equity is going to fund first, so the equity continues to fund, then the debt comes in later. I hope I answered.
Thank you. Sorry, yeah, you did actually. Sorry, this is also a conjoining question. Please, sorry, I'm taking this much time.
Sure. Go
Now,
ahead.
scenario whereby the for lenders or funders now actually funds the project, what would you recommend as an ideal, based on equity now this time around? What would you recommend as an ideal equity share for a lender to be comfortable? Thank you.
So that's the 70-30 debt to equity ratio I talked about. So of the project costs, you split it 70-30, right? So 70% of that would be provided by the debt providers, while 30% of that would be provided by the equity providers. That's usually the market standard. It can vary. So it is not like a set rule.
It's okay. It's okay. Thank you very
Okay.
much. I appreciate it.
All right, no problem. Thank you. The last point is security. So security, like remember I mentioned that it's limited or no recourse. So although there's no recourse to the ultimate owners, i.e., if it's like an established corporate, let's say like a Dangote, for example, they're trying to develop a refinery. So there's no recourse to the ultimate company. That's like, let's say the Dangote Group or the Dangote Industry Limited. But there's usually limited recourse to between the SPV and then the lenders. So the SPV would have things like it will have land that it's operating on. So you can get security in terms of like the mortgage on the land, right? Or you can get like charge on the account, or you could get like the different contracts. Some of the contracts, you could have direct agreements for the contracts. In the scenario where there's like a default, you can then step in to act like the project company in that scenario. So those type of security arrangements exist. So that gives you some kind of limited recourse, but it's not like full recourse to go into the ultimate owners to take all the assets or whatnot. So those security interests need to be perfected. And then next week, I'm sure in the legal session, you deep dive into that a bit. But you need to like, within the local laws in the country, the whole perfection process of like registering the security, ensuring that it's clear that is now in the name of these lenders, so that if there's an enforcement event, they can then go and enforce it and then claim whatever benefits they're supposed to claim from the security. Okay, so this is the last slide. Let's just run through this very, very quickly. I know we're running behind time. So now, having talked about some of the bankability considerations, we'll just talk generally about project appraisal. Some of these things may be repetitive, and I'll just breeze through quickly. So as a lender, remember in this scenario, we're putting on the lender's hat, right? What are some of the things you're looking out for? The sponsors and management review. So you're looking at the track record, the financial strength, the technical expertise of the borrower or the sponsors of the project. So now let me ask a question. There are two sponsors now that have come to you as or a project. There's a sponsor that has technical expertise, but only wants to put in 10% equity. Listen to the scenario. has technical expertise, but has only 10% of their money. They want to put in 10% equity. While is another sponsor that doesn't have technical expertise, but they've gotten like a technical team, but wants to put in 40% equity. Who would you be more akin to support, sponsor A or sponsor B?
Sponsor B for me. Why? The reason being that, can you hear me?
Yes, I can hear you.
So, for technicalities, right, those things can be easily contracted or consulted.
Okay.
But for that 40%, once you're in deep 40%, you're good to go in the lifespan of the project. So
Okay.
for me, B is a go. But
Okay,
those
what if
technicals,
B is also the 10% equity as well?
no, I won't go for 10%. Because now, if you go with those guys that have the technicalities now, once they get to a level, they can kick you out there from that 10%. 10% is nothing.
Yes.
It's nothing.
Okay. Okay, no, certainly. I think there's certainly a role that technical expertise has to play. There's a role that having balance sheet or having cash has to play. And it's usually the perfect world is to find sponsors that have both, so that you're supporting sponsors that have both cash and have technical expertise. But personally, me, like I feel like I don't know who was just speaking, but the people that will have cash can always use cash to get the technical parties to support them, right? But when someone just has technical expertise but has no cash, there's no real vested interest in the project because their contribution may be lower or whatnot. So it's just something to think about. There's no really right or wrong answer there. Technical analysis. So here you're just checking through the technology being proposed for the project design. Here your technical advisor would review also the assumptions that have been made, the technical assumptions that have been made, and just to ensure that they are indeed in line with market practice. Because remember, sponsors are very bullish, right? They are always optimistic. So they may be looking at always the best case scenario, or you then need a third party to come and confirm all the things they're saying. So another analysis would be the market analysis for a project that has a market that they're trying to supply to, like having to sell things, right? So you want to be sure that there's a demand for this thing they're producing, and then you usually provide like you get like a market report or a market study that shows that indeed there's a market that they can sell this product. Also, the financial analysis here, you're like looking through the financial model, ensuring that the project cost is within range. So because a project sponsor or a project can be done like at times to the price if somebody just wants to be like luxurious or just doesn't want to be prudent with cash. So you're always trying to ensure that you scrub the model, that the model is indeed reflective of a cost that a project of this size and in comparable jurisdictions have been done at, right? Also the sources of financing, profitability, look through the covenants and the ratios. Environmental analysis is also so important, especially like in this age of like where we're talking about net zero and just climate change as a whole. Like you want to be sure that you're building this project in a sustainable way that is not like impacting the environment, right? So you get an environmental advisor as well to ensure that like indeed all the environmental social impact assessments have been done. Also the environmental social action plan has been put in place, and then they're actually implementing the things that they said they would do, right? So this is so important. Legal analysis is also super important. The lawfulness of the project operation, that's like the review of the permits, review of all the licenses, the award process as well, because you don't want a scenario where like someone just gave a contract to their friend, right? You want to be sure that they went through a thorough competitive procurement process to award the contract or the license to that party, and then indeed they have the correct license for the tenure of the time they have it, and then they are able to like use it while they have the license for that duration, right? Also the change of law, you want to ensure that any change of law does not impact the project. So most times you're including things like stabilization clauses into the license agreement, so that in case there's a change of law, then the new government is able to like not impact like or change any policy regarding that agreement. But we know that like in Africa, there are nuances, right? Or not even in Africa, just in developing markets as a whole, there are nuances, like governments begin to change things. And then that's why you need to have like grounded your project as thoroughly as possible legally, so that if you then have to like go to court to kind of start like fighting legal battles, you already have all your documentation clear to show that you're in the right. Lastly, I believe is risk analysis. So here you're trying to analyze all the risk in the project, from the construction side to the political side, operating, environmental, social, amongst others, and then you're basically allocating it to the party best suited to bear the risk. Okay, I think this is pretty much it in a nutshell. So this is just like a snippet of our main broad session, but I hope you've been able to learn a thing or two. I'll pass over to Gbold now if there are no questions. I don't know if I missed any question in the chat or anybody's hand that is going up.
Sorry, I'd like to say something. Can I say something?
Sure.
Yeah, that your last slide before this, right? Is very, very important. This environmental assessment. Reason being that, okay, so I'm in the renewable energy space.
Okay.
I've been there for a couple of years now, maybe up to a decade. So you realize now how, aside just renewable energy, right?
Okay.
How environmental impacts could actually have a toll on a project.
No,
So it's very, very important that we pay attention to some of these details, right? And I like the way you delivered this particular presentation. Is well delivered. I appreciate it. Thank you very
thank
much.
you.
I thought I should mention that.
Thank you.
All right.
Thank you. Okay, Gbold, do you want to take it if there are no questions?
I think there is one more question. Daniel is raising up his hand. Daniel, you can shoot, please.
Yes, hello. Thank you very much for the awesome session. I really learned a lot. I just have one quick question. So, given that there has to be some contract signed between the project company and then the various stakeholders before the lender can fund. I always just wonder how those contracts look like. What if the project doesn't materialize? Is there maybe a penalty that the parties, for instance, may place on the project company or the sponsors? So maybe if you can briefly touch on that for me, please. Thanks.
Sure. Yeah, it's a good question actually. So so usually what I've seen is some of these project contracts are timed. They have like, first of all, even when you sign, they have like time before they mobilize for the EPC side. So the EPC contractor has to mobilize. So usually they are not based in the same country. Usually, maybe let's say they're coming from international space and they're coming in to do the project in your country. So they will have to mobilize, but there'll be a time frame for which they will have to mobilize, right? And then within that time frame, you would have hoped that you would have closed your debt financing, right? But apart from that, usually sometimes they don't sign anything. They just negotiate and keep them documents in a row, pending, like hoping that the debt conversations move quickly so that they can time the signing of everything at the same time. Because like you said, there are usually penalties and time starts to tick once you sign something, right? So because the other party on the other hand doesn't just want you to sign and not ever do the project. So they try to time as much as possible all the contracts, but you as a lender, you will need to see the sort of final form contracts, right? So final form contracts, i.e. all that is left is that they just need to be signed, right? And it's basically an execution version. So that's what you would review. That's what your technical advisor would review. And usually lenders are comfortable with that because they know that there are implications for signing contracts, right? So that's just what I'll say there. And maybe when Okechukwu is here next week, he will talk a bit more detail on the legal, like some of the clauses that maybe people put in to just exclude themselves from paying penalties if the contract doesn't materialize. But I hope that I answered your question in some way or form.
Yes, you did. Thank you very much.
You're welcome.
Sorry, one more thing. Sorry, please, pardon me.
Sure.
One more thing, Ndukwe speaking. You spoke mostly on the lender side. I mean, maybe next time, maybe at any point, try to compare both sides. So probably to give some level or a balanced, would I say, perspective.
All right.
Because some of us will be desirous to know what the lender or the borrower, would do in such a scenario. So thank you very much.
Okay, no problem. Thank you.
Is there another question? Okay, in the absence of any questions, so thank you so much, Victoria, for this wonderful session. I believe that everyone learned a lot, and as well, I also learned a lot as well. So we are having another webinar next week on the 18th of May, titled Navigating Legal Risks in Project Finance. So you can hop on BFI's Insight website, go to the events, upcoming event section, and you click on the webinar, you will see that they can be able to register. And as well, we also have another one as well coming up as well, which is going to happen on the 26th of May, which is understanding key ratios for assessing project bankability, right? We're also going to be looking at that as well. That one is happening on the 26th of May as well, right? So we have like 2 additional webinars coming up. These are the projects, these are basically the boot camps we have coming up as well. We have one in Abuja, happening on May 29th to 5th of June. It's a 6 days boot camp. This is basically the 5th cohort, right? We've had one for this year in Lagos, which was quite insightful. For the one for Lagos, is to happen on the 18th to 25th of July, right? Happening in Lagos and VIA in Lagos. Why for the one in Abuja is happening in May. So, and in these boot camps, we kind of dive into project finance. Like we look at everything from start to finish, right? Look at the legal part, the finance part, and as well the modeling part, right? So it would be great to have any of us join us in this section if you can. Yeah. So I think that's it. Any other question? Yes, you're going to get the recording section. We're going to send it across to your emails. Yeah, you're gonna get it hopefully by today. Does anyone have any other question to ask?
Yes, one more question. Ndukwe speaking again. So, thank you very much, Victoria. Thank you very much,
Promise is fine.
Promise, okay. Thank you very much. Promise. So I wanted to, I like this particular webinar because I've dealt in finance for a couple of years now. So I wanted to ask specifically, right? Do you guys have any sort of do you guys consult for this particular service, or it's just a webinar?
Yes, we do consult for it. Yes, as well. We do.
Please reach out to me. Ndukwe Madokwe is my name. I registered for this webinar. That's why I'm here. Or I can send you my email. Let's have further discussion, please.
Please, by all means, you can drop your email on the chat box.
All right, I'll do that. Thank you.
All right, thank you so much. Another question? Another question. I think Ose is on this call. Ose, are you here? Are you on this call, Ose?
Yes, I am.
Yeah, Ose was one of our students in the project finance bootcamp. So Ose, I think you should share one of your experience or your takeaway from the last bootcamp you attended.
Yeah, thanks. Okay, so I would say that it was a fantastic program. Actually, I was excited when I saw this opportunity for a refresher, and I'm looking forward to the next one, which has to do with the legal fundamentals. And yeah, in the program, I mean, apart from the finance fundamentals that we did for project finance and the legal, which were very detailed, in-depth, engaging, we also had the financial model, which was quite intense, and we learned a lot, especially with the methodology finance and project finance models. I was quite interested. So I recommend the program to anybody that is interested in knowing about project finance and the nuances involved in it, both from the finance perspective, from the legal perspective, and more importantly, the meat of it, which has to do with analyzing the project and the bankability, looking at the financial model. So thanks a lot, I promise, and thanks to Victoria and to the team.
Yeah. You're welcome. I think, yeah, thank you so much, everyone that attended this training. Yeah, please try to register for the next one. And we look forward to having you guys. Yeah, does anyone have anything to say? Are we good to go? Also, Victoria, thank you so much. Thank you so much for making our time to teach us. We appreciate that. And thank you so much, everyone that joined the training. We are grateful. So we look forward to having you guys in the next section. You have a wonderful evening. All right, bye.
All right, thank you, everyone. Bye.
Bye.